Well, hello, everybody. I guess we'll go ahead and get started here. It's 2 o'clock and time for another edition of the COPEC Daily Financial Wellness Webcast. Excited to have everybody here with us today. Today, we're going to actually have a really good discussion regarding some life insurance. And Jerry Snyder is going to be our expert today. So we'll go ahead and pepper him with some questions and discussion and have a good, thorough discussion on this. So just to go over some general information, again, make sure that we're taking care of some disclosures. Go ahead and take a few seconds to read this. And it has to do a little bit with the COPEC disclosure, also affiliated companies and retirement strategies as an affiliated company. So we'll give you a second to review that. Also, because there's so much there, feel free to go ahead and do a screenshot, or you can go to the copeceducation.org website, and down at the bottom of the page, you can see the disclosure there as well. So we'll go ahead and get going here. And regarding COPEC, COPEC's a nonprofit 501c3 organization that helps the community with free education. There's no cost, there's no marketing or sales pressure with any of our outreach. And so it's an education outreach program that we've designed since 2004 to be available to the community. And we're excited to bring this to you. Also, part of that outreach is the financial wellness outreach. And this has to do with a lot of the financial topics that we have found over the years that the public has been very much interested in. And so we've designed several new programs, including today's Wellness Webcast live streaming program for you to not only be part of that discussion, but ask questions and hopefully get the experts to participate directly with you. Technology-wise, we do have problems from time to time where we lose connections. So be patient. We'll try to get up and running as soon as possible. And then holidays, we will not be doing the programs, and that would include things like day after Thanksgiving and Christmas Eve. So just be aware if you happen to tune in, those programs will be skipped for those days. And then please feel free to share this with others. This program is available for everybody, designed primarily for Ohio residents, but it's okay. A lot of this information is for outside as well. And so you can see on the right side, we have a long list of speakers that we have from time to time. So we will be including those, and so you can see those here on this orange button here at the bottom of the wellness portal. This is on the COPEC Education website page portal, where those different August, September, those different orange buttons are different calendars of what we do coming up in the future programs, future months. And this is an example of those months. So you can see today, we do have a discussion on the 25th down at the bottom there. The insurance. Do we need more life insurance? That's what we're going to be talking about today. A little programming note update. Tomorrow on the 26th, we are going to have Russ Gollowin replace Jeff Foster for that day. So we won't be talking about the economy. We're going to do some legal discussion. So just be aware of that if you happen to be taking a look at that for tomorrow. And then also in the portal, we've got several other things. The retirement decisions programming, that is for those that are approaching and going into retirement. We go over a lot of different topics that has to do with, state teachers' pensions, public employee pensions, Social Security, private pensions, financial independence planning, insurances, Medicare, just a lot of those issues, so that hopefully if you're preparing for retirement, it can give you a really good feel as to whether you are on the right path. These programs we've been doing these since 2004. And while these were originally scheduled to be in person, unfortunately, due to the COVID, we are going to have to change that over to the webinar-based program through Zoom. So we're going to have those set up. We'll have that information out to you shortly for those September programs. Also, every Friday, we have a different presentation that is a lecture series from each of our speakers. And so this coming Friday, we're going to be doing the 10 critical aspects of financial wellness. And so, hopefully we'll see you there and tune in. Again, no registration needed. If you have an organization, department, company, whatever it might be, and you're interested in having us do a special program for your group, just go to this page here. Click on the orange link for some information as far as what we can offer. And then also on the right, just submit a request and we'll get back with you right away to see how we can help you out. And then lastly, on a personal level, because a lot of this information's, in a public domain, if you have questions and concerns that might be personal in nature, or we just didn't have time, to get to it, we would love to go ahead and be a service to you, guide you. Again, there's no marketing sales there as well. And it's just a matter of being able to help you in a private one-on-one setting. If you have any questions, concerns, you can schedule a 15-minute or just reach out to us directly. We can be available any way that you like and happy to do so. So, further delay, we'll go ahead and start our conversation with Jerry here. And Jerry, glad to have you here. I know that we share our hosting duties here, and today glad that I'm able to pepper you a little bit with some questions on some of your expertise on insurance. And today's topic is how much life insurance should I own? And you want to give us a little bit of insight as to what we're going to talk about today?
You bet, and pleasure being here as well. And Jay, don't be too hard on me today, please. I'll pay you back later.
Yeah, I know you will.
I've been in the business more years than I'd like to count. But when I first got into business, when it came to life insurance, and people would always ask us, how much should I have? And they always, the industry was always coming out with rules of thumb. And I'm not a big believer in rules of thumb, but there were a lot of rules of thumb. And the theory on that was really replacing one's income as a measure of how much life insurance should somebody own. And the theory too was when the wage earner would die, well, how is the family going to survive without that income? So it was a measurement of how much life insurance based on how many years of income should be calculated into the amount of death benefit. So, and again, so that the life insurance would pay off a lump sum, and then it could be invested to replace that income. Well, I heard so many rules of thumb. Should it be 6 times your earnings? Should it be 8? Should it be 10? And of course, at that time, we didn't have these sophisticated calculators. Now we have sophisticated calculators to help us and to customize that a little bit more for each individual. But having said that, I'm going to bring up a PowerPoint that I think might help us in the discussion. And really, it's kind of shifting gears here a little bit. Let's review a little bit about why you're going to have insurance in different situations and how can it play itself out in helping us determine how much life insurance we should have. We have a lot of retirees that come to us, they're ready to retire, and they say, Jerry, I'm going to lose my group insurance because I'm leaving my employer. And yet, Jerry, I don't have many debts, and my kids are out of the house, and they're doing well. So I guess I don't need any life insurance. While that might be the case, there are some reasons, and Jay, can you see that all right?
No, we're not able to see your slides.
Okay. Let me try to bring that up again.
There we go.
Good deal. So in that case that I just described, I'd rather have the client consider a couple possibilities here. Number one, if that person happens to have a pension from their employer, that pension is going to pay them out a monthly benefit for the rest of their life. And when they die, that pension is going to stop paying. And then if that individual has a spouse or significant other that he wants to share that pension with in the form of a survivor option, then he can choose to do so. and he could choose to share a full pension with them, the same as he's getting paid, or maybe 50% of that. So he or she has a lot of different choices. And so the point here where life insurance might come in is to give that survivorship option. The individual retiree is going to have to take, in some cases, a pretty significant reduction in their pension. In my example, let's say the pension benefit was going to be $3,000 a month. Well, to provide for the survivor to get half of that, if he were deceased, then he's going to reduce his pension while he's alive, but let's say $400 in my example. So instead of $3,000, he's going to get $2,600. So is there a better way? And that's where life insurance might come in. Life insurance that the individual already has, or it might even pay for him to buy a little bit of additional insurance rather than take that $400 monthly cut while he's alive as the retiree. Then maybe the insurance would only cost a couple hundred a month to keep going. So that's an example where the life insurance might still fit, even though he's retiring and doesn't have much other debts or obligations. Social Security, in a situation where both spouses qualify and are receiving a Social Security benefit. Well, whether you may know this or not, when one of the spouses deceases, whoever deceases first, they're going to lose one of those Social Security benefits. So that's an adjustment at that point. Now, we really encourage people to look ahead to make sure before they drop their insurance, or maybe even consider the amount of insurance they need, do consider that, because that's been a shock to many families. They go along and all of a sudden their pension is cut in half, or their Social Security, they lose one. How are they going to pay their bills? The bills are still coming in. So that's just something to be aware of and be careful of. Yes, sir.
Back to the Social Security, I assume planning has a lot to do with that, to foresee that, the what ifs. What if one passes away sooner than the other? And all of a sudden, many times we do planning, that's when you see the eyes kind of, the aha moment with clients that never really thought about, hey, we can cover our bills now, but oh my gosh, we lost one of those during that planning. And all of a sudden, it's like, how do we fix that problem?
Exactly, and that's what I mean by sophisticated calculators, very dynamic calculators that can look at all these different what ifs that can happen, and we can really get precise on, in this case, the amount of life insurance people should have. And we have a lot of financial planning programs coming up which will help us look at some of those different options. Another thing to consider, insure your children or grandchildren, and we're talking about preserving their insurability. And what do I mean by that? Well, of course, an insurance company, before they offer insurance to anybody, they're going to look at their age, of course, and their health, among other items, but those are two big ones. So no matter what age you are, they're going to look at health and age. Our concern there sometimes is, well, what if a child in the growing up stages becomes, unhealthy and would prevent them from getting any insurance or having insurance very costly. So one thought is some people like to, when they're very young ages and the insurance is just really, really inexpensive, maybe take a policy out on children or grandchildren. I did that for my daughter when she was about 8 or 9 years old. I bought her a $150,000 death benefit. Now she's 40 years old now. That was a pretty big sum at that point, but it only cost me $16 a month. Now, if we had invested, Jay, in Apple, stock, I can't argue that it would be probably worth a lot more, but I wasn't sure what was going to happen over that 40-year period. So I wanted to make sure she would at least have a decent death benefit, and it was so cheap to do at that point. Now, she has $16,000 cash value. Again, she could have done better in the stock market in hindsight, but, we've borrowed on that a little bit to buy her car. We borrowed a little bit of that to get her through another year of college. And so it was there, it was a discipline. And by the way, she has 4 children now, and her husband is working full time. And I never want to think about this, but what if something happened to her? Well, maybe this would help finance a nanny or something to help my son-in-law continue to raise those kids.
Well, and again, that life insurance policy is also tax-free, correct?
Yep.
And the idea of insuring their insurability, I mean, obviously, if something happened with their health along the way, it doesn't matter what another investment would do. You've locked in that insurability. So in hindsight, if you're healthy all the way to age 40, in hindsight, yes. But if she had an insurability issue, then obviously that would have changed the way we look back on getting these youth policies.
Well, exactly, and I'm not over promoting it, but it is something to think about for younger children to get that locked in. And I think she would always be happy to have that. So another reason, of course, people have it is to pay off debts, mortgage for one, particularly younger people that have higher debts maybe. Taxes is not too much a concern anymore. People used to buy it to pay estate taxes. Well, we've got such a high credit that's not comes into play too much. Funeral expenses, we had Mike Shutter on from Shutting Off Funeral Home the other day, and they actually sell prepaid funeral policies for that specific purpose. But he also mentioned he will accept older policies that people have and just kind of assign them over. So rather than maybe just throw away that policy or cash it in, it's something to think about, if you want to do that kind of planning as well. I already mentioned loss of group coverage. Again, so often a client will say, well, I'm leaving it behind because I'm retiring and I don't think I need it. But when we go through these financial planning calculations, they're retiring in their 60s. They're going to live to be maybe 90 or more. And so early on in their retirement, what if something happened? You need to take care of that spouse or other family members to get them financially independent for the rest of their life. And so we might calculate that, hey, it would really be helpful. Let's just take it out, a term policy for 10 years to get you up to an age where now you're going to be financially independent if one of the spouses were to decease. So that's another thing we encourage people looking at, and that's where the planning comes in again. Another idea too is to gift the life insurance. I know my church has a kind of an endowment program just for this purpose alone. And so they have these older policies, they don't need them much, but they have, 5,000-10,000 of cash value in them. It's a nice thing to remember charities or your church with. If it has a cash value in particular. So again, once the individual would decease, that charity gets the proceeds. And again, you can kind of get that out of your estate if that's an important item. The other thing is they might be able to use the cash value to help in their operations while you're still alive, and then maybe still have that death benefit. And some people tithe, they tithe their earnings into the church. Sometimes we talk about tithing your estate. So maybe your estate's worth 6, 7, 8, 100,000. Maybe 100,000 of it is the insurance, where you can make a sizable gift, more than you could in cash, by gifting the death benefit. The charity might have to wait a little bit, and hopefully for that to come through. But
right.
Another thing is creating a bigger estate. Now that's kind of interesting. But we have definitely had clients come to us and say, Jerry, I've got a pretty decent nest egg here and I've got some good income, but what if the market really goes south? What if we really have a sustained big loss in the market? And or what if I run into long-term care and I have to spend through my assets? I want to leave a certain amount to my children or grandchildren. How can I do this? Well, one way might be, again, to look at insurance. And we've had clients do that. They're funding a life insurance policy just to make sure that a certain amount is going to go to their children or grandchildren. Funding a trust, when people are doing estate planning and they're developing a trust, and that's a decision that some people do and some people don't go that route. But if they go that route, generally they may be trying to avoid probate or trying to make their estate more efficient and get everything planned out in advance. And they have particular estate planning wishes, so they develop a trust for that purpose. So if they have existing in life insurance, they might want to get that into the trust, and it actually becomes helping to fund the trust to pay the beneficiaries. And there might be certain situations, special needs, children or something like that, where they may like the idea of a guaranteed death benefit that's going to help fund their children into the future. Education funding. Oh my gosh, there's a lot of different methods of funding education. I would be the last to say that maybe this is the top choice for a lot of people. It probably would not be, but it deserves some mention, I think. Obviously, there's 529 plans. There's what's called uniform gifts to minors. And, you know, I think we're going to have other programs dealing with education funding. There's a transfer to minors. And so there's different ways to fund education, obviously in advance. But also, and again, in the case of my daughter, I really didn't buy that policy to help fund her education per se, but it did come in handy. And so it was a low-cost way to borrow some money at one point in time. So indirectly, it became kind of education funding. Maybe more importantly, though, is that you as the parent, when you're talking about, you know, your survival and replacing income that would be lost if you were to decease, well, you want to factor in education of children in coming up with the amount of insurance that, that you want to make sure that you have.